right. Good morning. Good morning. How are you guys this day, this fine day? What a crazy market. What a crazy market. Look at this thing already taking off and going to the moon. This is the S&P 500. Unbelievable. This is a really nice move. And just so you guys know, of course, I do I this is a good way to start the day. When I trade, just I'm not here to tell you guys what to do. I'm just telling you what I like to do. And I just share what I do with you. And so that's why I'm here and doing this. I do have the university class that I teach, and so I like those students to be able to come and watch and see where I practice what I preach. And so this is the S&P 500, and I have on the overlay the bulls and bears. All right, so the bulls and bears, what's turning the price bars red, yellow, and green. It's also what's throwing those arrows. Now I have it set up in kind of a very special way. I'm going to come in and show you the bulls and bears settings. And this is in Track and Trade, and it's a proprietary indicator that comes with Track and Trade. And you can see over here, it's got a sensitivity setting of 72. That's where I have it. And I have it set to progressive. And then we got red, yellow, green. And then I usually show the blue lights, but right now I've got those turned off just to keep it simple. And then down here, this is a filter that I turn on. It's called arrows on all color changes. And the reason I like the bulls and bears is because the bulls and bears is based on Fibonacci. All right. And I am kind of a Fibonacci aficionado. I like it. I like Fibonacci. And after doing this for 40 years, I've learned that it actually has some merit and it works pretty darn good. Now, most indicators are a little bit weird. All right. Let's run a couple of scenarios in here. I want to show you something. This is the S&P, and I'm going to shrink it down so we can get as much of it on the screen as we can. So look at this. All the way back here, we got these arrows that say buy, 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 sell, buy. They came in at pretty good locations, right? I mean, you got to admit those are some pretty good places to be buying into this trend. Now let's come on and turn on some of the arrows of some of the most popular indicators in the entire world, right? These are probably indicators that you guys, I'm going to turn off DMI for now, and I'm just going to use, let's start with stochastics just because it's simply the one I have on. So we're going to turn on stochastics. Now watch what happens when I turn it on. Which one of those arrows are you going to take? All right. Now you have to admit that is a pretty darn good arrow right there. And that is a pretty darn good arrow right there. But these arrows are what confuses everybody on stochastics. All right. All these sell arrows. Okay. So that makes it a little tough to understand how to use this tool. Now, I'm not going to go into a big, long, lengthy description of why it does that. But it's basically telling you the way we have to look at that is that's where it's going to tell you that there's a possibility that the market is oversold and to tighten your stops. All right. The problem with that is in an entire uptrend, it's telling you to sell, 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 sell out of your position all the way up through an entire uptrend. So just kind of compare that to what you get with the bulls and bears. All right. Kind of, yes, it does a fantastic job sometimes, right? Sometimes it does a fantastic job. You got to admit it. And right here, fantastic. Right here, fantastic. But what about all these, right? A little tough. So just to keep in mind, that's kind of why I like the bulls and bears in this scenario. Not that we can't use the stochastics. We certainly do. Now let's go over and turn on the MACD. We're going to come in here and we're going to turn on the MACD. And we're going to go back and we're going to start. I'm going to MACD, and we're going to turn off the arrows of the stochastics. So let's not display those. And we're going to turn on the arrows for the MACD. Now, the MACD is probably the best indicator out there, or most popular indicator out there. And again, let's brighten those up so you can see them. We'll make them light sky blue. Look at that. The problem is the same thing we have with the stochastics we have with MACD. Got to admit, pretty good arrow, right? I got to admit, fair. I mean, fair to middling, right? Fair to middling. You guys from the Midwest, we can say fair to middling. All right. And then out here, pretty good, pretty good, pretty good. But then what happened to all of these? I mean, what the heck, MACD? What the heck, MACD? What are you doing? All right. So let's go and let's turn on CCI. CCI. You guys have all heard of CCI. CCI is probably one of the most important indicators you could ever have. Just have CCI and you're rich, rich, rich beyond your wildest dreams. Right? We have CCI. Let's come in here, turn on display CCI. Now, CCI, a little bit better, isn't it? A little bit better. Not quite like the others. This indicator is not quite like the others. All right. So pretty good. Got to admit, pretty good. Oh, CCI, pretty good, right? Well, pretty good. CCI, not too bad, right? Oh, wow. CCI, a little bit better there than MACD. Whoa, that's kind of cool. MACD, CCI, stochastics. What are we getting here? But still doesn't outperform that that bulls and bears. Fibonacci rules. All right, so let's come in here. Let's go ahead and we're going to delete all of these arrows. CCI. Let's go look at RSI. Oh, everybody loves RSI. RSI is on every chart you ever see. Any chart you ever turn on nowadays has RSI on it. If I could spell, I could find it. PQRSI right there. Let's go turn on RSI. Look at RSI. Oh my gosh, look at all those arrows. No, I haven't got them turned on. Come on, turn them on, Lan. RSI. Wait a second. RSI. RSI. What are you doing, RSI? RSI. RSI is supposed to be the best thing that ever happened since sliced bread. Well, not too bad here. Not too bad here. That's the one came in kind of good on that one. Little nice one, but I mean, little fair to middling. But then you get this one and this one and this one. And what about all those? RSI. RSI. I'm not feeling it. I'm not feeling it with RSI. Oh, let's see. Let's go in. You've done all the most popular indicators in the whole world there, Lan, and none of them can touch a candle. Well, CCI, close, comes in at a second close, right? But the rest of them kind of fail miserably compared to our bulls and bears. Why is bulls and bears so good? Well, bulls and bears are so good because it's a proprietary indicator that Lan made up. I didn't actually make it up. I wish I could claim it, but I didn't. I used to work, for those of you who don't know, I used to work at a very important place. All right. Let's come in here and I'll pop that up for you. Lan Turner is a former instructor at the Chicago Mercantile Exchange and the Board of Trade's Education Center. Did you guys know I used to work back in Chicago at the exchanges? I used to go back there all the time and teach in the education center. I did that for about 10 years, from 2000 to 2010. I learned so much more than I ever taught. I learned so much more than I ever taught. And this is the stuff that I learned. All right. This is one of the things I learned. And I learned this from a huge fund manager. And the guy actually lived, he was a big fund manager. He had lots of money. He lived all over the world. And he managed a massive fund. And he was teaching a class back there in Chicago. And people paid thousands of dollars to go to this guy's class. And because I was a teacher there, I got to sneak in and sit in the back of the class without having to pay. That's a good idea. Go and sneak into every single one of those classes at the education center that you possibly can, Lan. That's what I did. I went in there and I snuck into every single class. I know I had to teach my own classes, but when I was teaching, But then when I was not teaching, I was learning. And they didn't make me pay. So I got to sit probably hundreds of thousands of dollars of education I got for free at the Board of Trade when I was there. And they taught me all kinds of really cool stuff. And that's what I like to teach you guys here. I like to come here and I like to teach you what I learned. And one of the things I learned was Fibonacci. And that was one of the most important things. And then this guy said this is how they would manage their huge funds. And he showed us the mathematical formula. And I was like, oh, well, that's pretty cool. And at the time, I just kind of like logged it in the back of my head. And then I would go to classes I'd have my own classes, not at the university, not at the Board of Trade. I would travel around with members of the Board of Trade or individuals who also taught at the Board of Trade. And we'd go do our own seminars. And when we were there, I would draw on the board. I'd say, okay, this is how these big fund managers do these mathematical formulas, and I would draw it on the board, and I would draw it on the board, and I would go and I'd teach this to people, and people would say, "Well, Lan," I had one guy, and it takes somebody to knock it into your brain sometimes, right? To say, "Lan, why don't you create an indicator in Track and Trade to do that for us, so we don't have to do it all manually?" And I was like, I wonder why I didn't think of that. That's a good idea. Sometimes, you kind of brain dead, and some guy had to tell you, point it out, say, "Hey, why are you doing this all manually? Why don't you just create it? You're programmers. Create it for us." And I was like, that's a good idea. So I went back that very day to the office, and went into the developer's room, went up to the whiteboard, and I drew the whole thing out. Drew the whole thing out, all the rules, everything that went along with it, all the math models. I drew the whole thing out on the board, and I used all colored markers, so it was really cool, all the colored markers, and had it sitting there on the board, and it sat on the board for, I don't know, 2 weeks. And I told the programmers, I said, "I want you to program this in." And they're like, "Oh, that's hard. We're not going to do that. We're busy. We got too many other things to do." You know how programmers are. "Oh, put that in the queue. We'll get to it next year, maybe." It was one of those things. So it sat on the board for like 2 weeks. And then they came to me one day and they're like, "Lan, can we erase that? We need to use the board." And I was like, okay. So I went and that was back when digital cell phones or digital cameras were, I don't think we even had cell phones back then. This was when digital cameras were around. And so I went and took a digital camera and I took a snapshot of it and I uploaded it and I printed it. And that was back in the days when they first coming out with color inkjet printers. Remember inkjet printers? And I popped that off and 30 minutes later, I had a color print of my Bulls and Bears formula. And I took that and I stuck it in the bottom of my inbox, and it sat on my desk. And I just kept teaching it manually. Just kept doing it manually, the old way that I'd been doing it. And one day I was looking through my box and I saw that old colored print. And I was like, why don't we do that? And I walked down and we had a new programmer. And I walked down and I dropped that on his desk. I said, "How much time would it take you to put that in there? Could you get that in there for me?" And he looks at it and he goes, "Oh, probably take me a couple weeks." And I said, "Okay, well, I think it's worth it. Why don't you go ahead and that's your first assignment. Why don't you put that in there for me?" And he says, "Okay." About 4 hours later, he comes trotting up the stairs to my office and he goes, "Done." I was like, you got to be kidding me. We've waited a year and 4 hours to get this thing into the software. So that's where Bulls and Bears came from. And it's one of these tools that they use to manage enormous hedge funds. The guy was teaching in Chicago. I mean, he wasn't in Chicago. He was not in Chicago. He actually had a house in Park City here in Utah, and I'm in here in Utah, and he had a house in Park City. And he says, "Oh yeah, my house is really cool. I can just go right out the back door, ski right out onto this lift and go right down into Deer Valley and up on the lifts. I got an annual lift pass and it's really cool. You should come to my house sometime." So he invited me up to his house for a barbecue. And so I'd go skiing with him, and I never went. My dumb, stupid, I got nasty words to say about myself about not going up to his house with him. I never did go. He taught me how to do all this stuff and invited me to his house, and I never went. Never did connect up with him after that. And he's the one who taught me how to do this Bulls and Bears stuff. And he was the one who was managing massive funds using this mathematical model that we put into the Bulls and Bears. So that's where the Bulls and Bears comes from. I wish I could say I made it up, but I didn't. I did do the color coding. I'm the one who changed the colors of the bars to make it do red, yellow, and green based on the mathematical models. I mean, I added my component piece. I did add my component piece. But that's where the Bulls and Bears comes from. So the point that I'm trying to make here is that if you come into the Bulls and Bears And I use it with these settings for investing and to trading. Mostly I use it for longer term trends. Have it. We've got this section in here that helps us do the count the we use those blue lights to help us count the Elliott waves. And the whole idea was that we had Elliott wave and Fibonacci working simultaneously together to give us that 1, 2, 3 knockout punch. It's the thing I call it's our strategy. So we got the count, measure, setup, trigger, and follow through. Now, for count and measure, that comes from the count side comes from Elliott wave, right? So we count the waves of the market. We know that the statistically speaking, markets have a tendency to go to run through 3 drives. Doesn't mean they can't go 4, 5, 6, 7, 8, 9, 10. They certainly can. All right. Doesn't mean they can't stop at 1. They certainly can do that too. But statistically speaking, we see that markets have a tendency to go to the 3rd drive 1, drive 2, drive 3. Now in this example, this S&P market was quite wild, right? It's a really strong market. And we see that. My goodness, hold on. Let me drink some tea. All right. So this market was really super strong. So that's why we saw 4 drives in this last drive. So there's drive 1, there's drive 2, there's drive 3, and we got a 4th drive up there, which is a unicornish, right? We don't generally get that 4th drive up in there. And so we generally don't want to start being buyers up in this region because the probabilities of the market taking off and continuing higher above 4 drives is pretty rare. Now, it happens a little bit more in the indexes than it does in the individual regular stocks or, over in the stock market or over in the futures market with some of our things like crude oil, the grains. They love Fibonacci. They love Elliott wave. They love to trade those markets like that. Of course they do. They're in Chicago. That's where I learned all this stuff, right? So of course they're going to be very sensitive to these strategies, and so we don't generally want to go much beyond that 4th drive. That's the point I'm trying to make, and we stuck that into the bulls and bears, all right, to give us that count. So we count the waves. That's Elliott waves, right? So we got to learn Elliott wave. Now you don't have to learn all the stuff that's in Elliott wave. And people correct me on Elliott wave all the time, and I'm like, you know what? Go correct yourself on Elliott wave. I don't give a poopy about Elliott wave beyond the basics, all right? Because in my opinion, that Elliott wave book is about that thick. And the first chapter tells you almost everything you need to know about Elliott wave, and then the rest of it is just excuses on why it didn't work. So throw that out and just say, look, you know what? It has a tendency to do 3 drives. And that's all we really need to understand. It's a 3 drive pattern. And we look at the 3 drives, and we can look at the 3 drives up, the 2 drives down. Sometimes it'll make 3 drives down. There, Elliott wave. Now you know everything you need to know about that 4-inch page, 4-inch thick book on Elliott wave. Okay, so we use the blue lights to help us count the Elliott waves. That's pretty simple. And then you just understand the simple nature of it. This is your trend and your counter trend, right? Your trend and your counter trend. Your trend and your counter trend. Now we don't want to trade the counter trend. We use the counter trend for entry into the new trend, but we don't actually trade the counter trend. So if a market's coming down, the trend is down. You don't want to trade the counter trend on the way back up. You want to look for that market to make those waves like this. So we don't actually try to get in right here, right here, and get out right here. That's too small. We don't like to trade the counter trends. The trend is your friend until it bends or ends, right? So we want to ride the trend. The trend is the longer trend. This is the trend. And then we get the little counter trends. And so that's where Fibonacci comes in. Fibonacci measures these Elliott waves. So a lot of people I see on the internet, they try to use Fibonacci and they don't know what they're supposed to be measuring because they don't know Elliott wave. But the whole idea of Fibonacci is just a ruler that measures something, right? It measures the trends of the market. But half these guys, they're out there measuring things and they don't know what they're measuring. They don't realize they're supposed to be measuring Elliott waves. All right, so go watch some of these guys. It's funny. It's funny to watch them. Once you understand what Elliott wave is and what Fibonacci is, and you understand they work hand in hand, one to the other, and then you go out and watch these guys. They only know one leg of it. They don't know anything about Elliott wave. They only know Fibonacci, and they're out there drawing Fibonacci rules and stuff. You're like, dude, get a clue. That's wrong. Okay, because there is a wrong and a right to doing this stuff. And you want to do it you know what, it's like everybody's like, well, just do it my way and it doesn't matter because if it works for me, then it works. Okay, well, great. But the reason we want to know the right way is because that's the way the guys in New York and in Chicago do it. All right. And they're the guys who move the markets. They're the guys who trade hundreds and thousands of contracts. All right. Hundreds and thousands of shares of stock. So you want to know what they know. You want to do it the way they do it. So just because somebody gave you an Elliott wave tool or somebody gave you a Fibonacci tool and you can draw it on your chart in the bedroom of the basement of your mom's house doesn't mean you're doing it right, and doesn't mean it's going to, get the point. Okay. I'm going off on it, but the reason you want to do it right is because that's the way the big boys do it. And they're the ones who push the markets, and you want to know the same thing they know. So you need to understand Elliott wave because that's what they do. You need to understand how to draw Fibonacci rulers because that's what they do. All right. And you want to do it the way they do it, which is to measure the Elliott waves. Okay. That's the point I'm trying to make. And then the setups and triggers. Now they have setups and triggers, and a lot of this stuff is all mathematically modeled, and they're having quant style systems, and they're having computers that do it. We've done interviews in Pit News Magazine with a couple of guys who manage those things, and usually they're not doing it. They're not just sitting there clicking the mouse like you and I do. They decide they want to trade a certain way. They click the mouse one time and they turn the computer system on and it runs that strategy. And then when that strategy's over, they turn it off, or it turns off automatically. And then the next one they turn on, and they turn on another strategy. So they only click the mouse once and it trades for the next, 4 months or 4 hours or whatever. And then that's how they do it. Now, it doesn't mean they don't get in there. A lot of those, managers will go in and do manual trading. We did that. We listened to that interview on Jim Cramer, and he was telling, right, in Pit News Magazine, we had that interview with Jim Cramer, and he was telling people how he was teaching hedge fund managers how to manipulate the market, and they do it manually. They weren't doing it with systems. So, of course, that was back in an older day. Maybe they do it, they just probably automated the exact same thing. But at this point, we need to understand from small speculators, what are we counting the Elliott waves? Why? Because that's what the big boys do. Fibonacci, we need to understand how they draw their Fibonacci rulers. That's how they do it. We need to understand it. And then the setups, what setups are they using? Because they use the same setups we do. They trade the trends. The trend is your friend. It doesn't matter how big you are. You got to trade the trends, right? But they create trends. So they have a little bit different model. We talk about the Wyckoff model. We've been doing that a little bit, and I'll teach you the Wyckoff model. And then, of course, the triggers, what gets you into the market. How do you manage it once you're in the market? How do you get out? How do you get out of the market? So count, measure, setup, trigger, and follow through. Getting back to the basics. That's what our little marquee was out on the on the YouTube window thingy thumbnail. Getting back to the basics. And so I wanted to get back to the basics and talk to you just a little bit about count, measure, setup, trigger, follow through. I want to show you why the bulls and bears is such an important tool against all the other indicators that everybody says are the best indicators in the world, but they can't hold a candle to the bulls and bears. And when I do investing, and I like to do short-term scalping and speculating, and I like to do that primarily in the futures market. I like to do it in the stock market. I haven't been doing so much of it lately because I've been teaching these classes, and those kind of have to be done first thing in the morning. But we've done a little bit of that together, right? Where we go over to the stock market. We look for, I use FinViz. What's it doing? Here we go. So I use FinViz. It's a program I like to use. And I like to use this little tool right here called the bubble indicator. And so I've taught you this, and we'll do some more of this, but this is how I find the markets that are rocking and rolling. And then we go over and we buy options on them, right? And we just do short-term trading. And we've had really good success doing that. But once we do that kind of speculation, we need to invest in longer-term trades, right? We need to be investors as well, not just traders, not just speculators. And so what we do is we take the money that we make from, doing aggressive options trading. We've been doing a lot of 0 days till expiration options lately, been trying to perfect some of those strategies. But once we make some money, we need to take it over and put it into an investment strategy, not quite so aggressive, right? Something that we can just invest in markets. And the point that I'm trying to circle all the way back around to is when I do that and I have an investment that I go into, for example, like the S&P 500, if I'm going to buy the SPY, Let's turn off all these RSI arrows because they're confusing. If we come over to this chart, this is where I buy. Okay, this is where I add on to my long-term positions. Anytime I get a buy arrow, this is where I will put more shares into whatever stock, bond, ETF, fund, individual stock, whatever it is that I'm holding over a longer period of time. This is where I add into my positions. All right. So I look for this. It's a great opportunity to see these because then you know that you're going to have a buying opportunity to put into the market later. And if you come back and look through time, you can see, where you can do your dollar cost averaging. You get some, where the market's coming down like this. But if you do your Elliott wave pattern, so there's your 3 drive pattern, drive 1, drive 2, drive 3, right? We learn Elliott wave. Then we want to know, we can count and measure. Here's our 3 drive pattern up. Drive 1, drive 2, drive 3. So markets have a tendency to move in these 3 drive patterns, and you can use these arrows to help you identify where the market's moving through the drive patterns. And that's how you determine where you need to be dollar cost averaging into your longer term trades. All right. So that's how you use the bulls and bears to help you do investing. And of course, I wanted to show you that's this little feature right here, arrows on all color changes. Now, if you turn that off, you get one buy arrow for every sell arrow. Okay, so it's kind of a unique style in that regard. So let me get rid of the drawing tools. So now you can see it's just going to go, if you turn that arrows on all color changes, which is the breakout of the Fibonacci sweet spot for the Fibonacci ruler. So now you just get the bottom of the trend, you get the top of the trend, you get the bottom of the trend, and you don't get any of that junk all the way up through the middle like you would get like if you turned on MACD or RSI or stochastics or CCI or any of those. Okay, and so then you get a little bit different view coming down through here. But nonetheless, you want to make sure you're counting your waves for the Elliott wave, learn your Elliott wave strategies, and then also learn Fibonacci, how to measure Fibonacci, but then you have the bulls and bears to help you with that as well. And there's also another really cool tool that we've significantly enhanced here in Track and Trade called the Zigzag tool. All right, it's another Elliott wave tool that helps you count Elliott waves and Fibonacci, but you have to kind of tune it. It's a manually tuned, and so I just manually tune it to the bulls and bears, which is why you don't see me use it a lot, because if I'm going to just tune it to the bulls and bears, then I'll just use the bulls and bears. All right, but it does help you identify those Elliott waves a little bit better. If you'd rather use that instead of the blue light, we can do that, turn off the blue light, and now you can use the Zigzag tool once you've tuned it in, so it's doing the same spots. You can see it'll calculate Fibonacci and Elliott wave for you, and it's a really cool tool. Not to downplay it, it's a wonderful tool, and I love it. Spend a lot of time working on all these features and everything, all these setups to make it do what it does. But nonetheless, I have to tune it into the bulls and bears to get it to the right settings. So there is an auto scale. You can hit auto scale, but auto scale just does that. Just gets it on the screen. And I want it to be more sensitive. So I turn on, I go back over to the bulls and bears, turn on the blue light, and then see where all the breaks are. That tells me where the drives are in Elliott wave. And then I come in here and I use the sensitivity. Oh, not that one. I want that stuck to 72. Then I come over to the zigzag, and then I move the sensitivity slider on the zigzag to match up to the bulls and bears, and then I have it tuned in. All right. So it's kind of like an old radio in an old 1972 Ford pickup truck. As you're driving down the road and wanting to listen to music, you have to tune in the radio, right? No more digital stuff back in those days. You had to tune it in. It's the kind of same thing you're doing with these indicators. You have to kind of tune them in to what the market's doing, and then you get the right channel, and it works a lot better that way. All right. So there's the Elliott waves. You can see drive 1, drive 2, drive 3, the retracement. We're back into drive 1, drive 2. Now, these are the Fibonacci calculations in here. So you can see that this had a Fibonacci calculation or a Fibonacci extension of 220. It had a Fibonacci retracement of 20%. And then it had a Fibonacci projection of 269 with a 35% retracement, a 259 projection with this one had 100% retracement. And then we start back into this next one. We had 109% projection with a 40% retracement. And so it measures and counts your Fibonacci numbers for you in both projections and retracements. And that's what the Zigzag tool does. And it's a really cool tool. All right. So then we look for the setups and the triggers and what gets us into the market and the breaks above previous highs and lows and then within the Elliott wave tool, this is where you end up with all of your patterns. This is where people are, drawing their triangles and wedges. You realize that these little counter trends, this is where you're going to get your triangle formations like this, right? Little triangles that people talk about. Oh, I only trade triangles. Well, did you realize that the triangles are the zones between the drives of the Elliott wave? Oh, what's an Elliott wave? Exactly. Why did you didn't know that? Well, if you would do a little bit of extra study, you would know that that's where your triangles come in between the drives. Those are the counter trends. Also, what about head and shoulders formations? Well, head and shoulders formations are the reversal points of an Elliott wave. So if you come in and people are going, oh, well, I know all about head and shoulders formations. Well, did you know that a head and shoulders formation is the bottom of an Elliott wave, the reversal point going into a new Elliott wave the other direction? What? What's an Elliott wave? And then it's the same thing on the upside. If you get a head and shoulders on the upside, you have your same patterns going in on the upside, right? So you end up with an Elliott wave to the downside. So that's the topping formation. The head and shoulders on top is the reversal of the Elliott wave on the third drive. That's where we're going to put in our head and shoulders formation to the upside, to the downside. We also have 1, 2, 3 top formations, 1, 2, 3 bottom formations, which are just smaller head and shoulders formations. But you have all of these different tools that you've been led to believe are important and familiar with: head and shoulders, 1, 2, 3s, top triangles, wedges, pennants, all this kind of stuff. They're all component pieces of Elliott waves. Okay. So the Elliott wave and the Fibonacci stuff is the core fundamentals of all those different patterns and how they all work one with another. And if you don't know all that, you kind of don't understand that full 5-step process: count, measure, set up, trigger, follow through. You don't know what you're doing. Well, Lan has a book for you. How about that? Of course, I have a book for you. This is the manual to the class where I teach all this stuff that I learned when I was in Chicago. All right. They taught it to me. I got $10 million worth of free education when I was there. And so I wrote as much of it down. My son said he started wanting to trade. And I was like, well, if my son wants to trade, I guess I better write down everything that I think he should know before he starts trading. And so that's what I started to write this stuff down for, because I wanted him to know. I was like, okay, I got to explain to him Fibonacci and Elliott wave. So this is the Elliott wave, Ben. This is how you read an Elliott wave chart. This is what I was taught when I was in Chicago. This is how those guys do it. So I want you to do it the way they do it so you understand. So I started writing this stuff down for him. And I actually wrote it down, and gave him examples. I said, see, I traded this chart today, and I captured the chart, and I showed him how I did it. And then I put down this, and I wrote down this, and then I wrote down this, and then I explained what the Fibonacci counter trends are, and I call this a spider web, and I explained all that, and then I explained where the entry points were, the setups and the triggers, and I wrote all that stuff into the book. And then I said, well, see, here's some charts that I traded today. So I screen captured them and put them into the document, and I sent them off to him. I said, now here's some more examples of where this works, and this is how they do it in Chicago. And I want you to know, if you're going to trade, I want you to do it right, because I don't want you to lose all your money. And I just kept putting in examples and showing him how to do it and writing it all down and showing him where the Fibonacci rulers work. And then I showed him, hey, this is all of your probabilities. This is where you have to look at the probabilities of the market. It's like going to the blackjack table, and you have your little player's card. We do the same thing with the stock market. So we have these little player cards, and we know what the probabilities are. And so this is your probabilities key right here. And then this is where we're going to set it all up for you and show you how these markets work. And this is how we count it. This is how we measure it. And then we go into the Fibonacci. Now here's how you do Fibonacci. And here's where you do all this. This is how the Fibonacci bow tie and the Fibonacci projections come into play. And this is where they all work into each other. And this is where the support and resistance lines are. And here's how you do the Fibonacci cone of probability. And then I draw in examples. And I'm like, this is how you do all this stuff. And I would just go through and, okay, now here's your setups, and here's your triggers, and here's where these things work into the Elliott wave patterns. And so I would go through, and I just did all this stuff for him and put it into this book. And I explained it all to him. And that ended up being a book that I decided, well, heck, you know what? I just use this for the manual for my class at the university. And I will also just throw it out there on Amazon so you guys can have it. So if anybody wants it, you can just go get it. It's on Amazon. It's all the secret tricks and stuff that I learned when I was in Chicago for all those years. And heck, it's out in Amazon. So here, I'll show you where to get it. Why is this thing being so slow today? So there's my book on Amazon right there. So if you want to go get it, that's what the cover looks like. All right. There's a couple of different older versions out there. Don't get those. I don't know why Amazon won't take them off, but you search Land Turner, you get a whole bunch of my old stuff too. But I want you to have everything's been compiled into this new book, Stock Market Playbook of Strategies. Just search Land H Turner. If you don't put the H in there, it won't come up either. You got to search Land H Turner, and there it'll be, and then it'll have. So there's the cover, and that's what the cover looks like. Don't get the old book. And there's a little scanner code right there. You can scan that little code, and it'll take you right over there. And you can get the manual. And it's not expensive. I don't make a whole bunch of money on it. Amazon takes all the profit, but it's about what, 20, 30 bucks, something like that. I can't remember. And so you can get that book, and it tells you all of the setups and the triggers and the count, measure, setup, trigger, follow through, and how all this stuff works, getting back to the basics. All right. So that's how all this stuff came about. And that's why I teach the way I do. And that's why I try to help you guys understand what I learned when I was in Chicago, and I teach it at the university. And this has served me well throughout time. I have some pretty big portfolios that I work off of, all based on this information and how I make my living. All right. So that's how I do it. I'm not telling you what to do. I'm just telling you how I do it. And if you want to do what I do, I just published it in that book, and you can go get the book. It's not like I'm going to get rich. All 21 people, watching my class, going to go buy a book. It's just something I'm trying to do. It's just fun. I enjoy it. And I have to have a purpose in life too. So this is my purpose. I like to come out and continue doing what it is that I do and love and live, right? Teach people how to trade using the basics and the fundamentals of trading. And that indicator, bulls and bears, is part of that. You can get that in Track and Trade. Where's Track and Trade? Track and Trade is right here. So it's in Track and Trade. Is it in any other program? No, it's just in Track and Trade. And so you have to go get it out of Track and Trade, but you have to get, this is the futures version. This is the stocks version. There's the little scan code. You can go get it over there. Stocks and Commodities, Reader's Choice Award, 6 times, actually 7 times. But that's it's a good little program that you can use to help you do your analysis of the markets the way we did it back in Chicago. All right. And that's the fundamentals of understanding how this stuff all works and comes together. So now when we come down and we start to trade on smaller time frames, let's go over to let's delete this chart. We'll pull up the rest of them. I got to drink some tea again. Hold on. All right. So that's the way this works. This is the way the system works. Let's come back over here now. We're going to look at 4 different charts all simultaneously. Now, sometimes when I'm down looking at a little tiny time frames and we're looking at the markets, these up here in the upper left-hand corner, we have the S&P 500. This is a 15-minute chart because that's where we like to put our options on. And then this is the Dow up in the upper right-hand corner, and it's a range bar 6 chart. Bottom right-hand corner, this is the NASDAQ 100, and it's a micro mini chart. And then over on the left-hand side, we have the Russell 2000, all right? And that's a range bar 6 chart. Now, we also have Heikin Ashi turned on all these bars. I like Heikin Ashi. A lot of people don't like it. They don't use it, but it's fine. Yeah, do what you want. It helps me see the trends a little bit better. I've also got the bulls and bears turned on. And if you come over and you look at the bulls and bears settings, I have that arrows and all color changes turned on. So it's going to give the continuation of the breakouts of the Fibonacci sweet spot. And that's what that really does. Okay. So the yellow zones are the Fibonacci sweet spot. It's if you draw a Fibonacci ruler, all right. If you draw a Fibonacci ruler, you can see, well, let's draw it up so it's a little bit easier to understand. Okay. You got A and B. So this is if the market comes up like this, it comes up through the Fibonacci ruler. So let's say it's coming down and it touches a low, and then it turns and it rallies up. It goes up here. This is the peak. And then when it comes back down, it comes back down into what we call the Fibonacci sweet spot right here, right? So that's somewhere between 38.2, 50, and 61.8. Now, some guys will get really anal retentive about that thing's got to come right back to 61.8. And if it doesn't, then they get all nervous and upset because 61.8 is the golden ratio. But this is not engineering. We're not building buildings, all right? So there's lots of humans involved. And so humans, the guys in Chicago, the guys in New York, they're the ones who are anal retentive. They want to see it come back to 61.8. But you've got all these ding dongs out there on YouTube who don't understand this thing completely. And so when the market comes down to 61.8, although those guys want it to, and that's where they're trying to drive it to and trying to wait for it to get there, some of the ding dongs don't know that. So they'll start buying at 38.2, or they'll start buying at 50, or they'll start buying down in here. And then the market will turn and start to rally up in here and come out of that, what I call the Fibonacci sweet spot, somewhere between 38.2 and 61.8. So that's why, it's not going to be perfect, because you got the guys who want it to be perfect. They want it to come down and touch the exact golden ratio. But then the rest of them are just like, it's close enough. It's good enough. Or they don't even know. They just market turned and started to go back up because some other guy just started to push the buttons. So they all start pushing the buttons at a different time. It has nothing to do with the Fibonacci projections or anything. And there's a lot of that kind of stuff that goes on in these markets too. You got to take into consideration, not everybody knows what they're doing. And so the market does weird things sometimes because it's groupthink, right? It's like, it's like a bunch of sheep. The market starts to do something, all the sheep jump on. Even though it didn't hit any of the specific rules that the big boys in Chicago or New York were waiting for, or trying to, it's like, what are you dumb retail traders? What are you doing? I mean, my gosh, it didn't even hit the 61.8 yet. Why are you guys all buying right now? There's a lot of that goes on. All right. You retail traders screw up everything. Make it so frustrating for those of us who know what we're doing. So it makes it a fun market, right? That's why it's a market for everybody. Everybody gets a guess. All right, as old Mark Peterson would say, everybody gets a guess. So look at this market go. That's a beautiful run right down there. So that thing's come down, started to die a little bit down here. And now it started to roll higher. We need to look at the news. We also have the economics of the market. We don't want to just think that everything's the technicals, because that's what we just talked about, right? Count, measure, setup, trigger, and follow through. Those are the technical nature of the markets, but we also realize that the fundamental nature of the market is what drives the long-term trends. The technicals are what gives us the setups, triggers for entry and exit of the market. So we have to know when to get in and out of a market. We do that with the technical setups, right? The mathematical models, the crossing of trend lines, the bulls and bears, those types of things. But we only want to do that kind of stuff on good fundamental markets that have good fundamentals. Fundamentals meaning a reason why the market might rise. Now, this is the trading economic calendar, and so we're going to look at that for here just a second. Here you can see us for Thursday, June 13th, 6:30 this morning. We had the PPI. What is PPI? PPI is the producer price inflation month over month. So producer price information. See that? It went down. So that's good news. So generally, you would expect with good news that the market would go up, and it did. If you come back and you look at the S&P 500, right here, let's bring it up full screen. You can see there's where it went up. That's where that PPI, see that? That PPI came out at 6:30 a.m. That's my time, UTC 6. You're going to have to make the adjustment yourself. So UTC 6, that market took off and started to run like a banshee at 6:30 on that good news, and that's what caused that big run right there. All right. So we realize that the fundamental nature of markets is what drives the long-term trends. If we have good news, markets want to rise. If we have bad news, markets want to fall. But when a market starts to rise or fall, we need to have setups and triggers, points of entry, points of exit. And that's what the technicals are all about. All right. So the technicals are what tells us when to get in, when to get out of a market. And so that's what we do with, that's what you learn in my manual. Okay. Is all the technical stuff. But we also have to be very mindful of and pay close attention to the fundamental nature of the markets. So this was all that happened at 6:30. We had the PPI, we had the core PPI month over month, and then we had initial jobless claims. Now, jobless claims, the PPI was tagged as red, and that moved the market big. Jobless claims are usually pretty good too, and so they all came in. And the problem with jobless claims this time is that we had forecasters to be 228. We actually had 242. So that kind of put a damper on things too, because that's not good news. You don't want to have more people filing for unemployment. And that's what that is, telling us we were forecasting to be 228, and there's actually 242,000 people, new people claimed unemployment. All right. So we got at 10 o'clock today, we've got Fed Williams speaking. He's a 2 impact. He's not going to change anything. He's just going to kind of give his opinion, and nobody really cares what he thinks. So it's not going to move the market a whole lot anyway. And then the 30-year bond auction is not going to move the market either, unless you're maybe trading the bonds. Okay, so we're going to come in here, and the big news for the day is over. We got some more big news tomorrow. And actually, you know what? It comes in here and says tomorrow is the Michigan Consumer Sentiment. That thing rarely moves a market. I don't know why they even tag it as red. I think the people who make up these, it's all politics. We won't get into that. It doesn't move the market very often. Sometimes it does. I've seen it really make the market take off. So I guess it depends on how much of a change it makes. But usually it doesn't change the market very much. And they tag it as red every time. And I'm like, why did they make that red? It didn't do a thing. All right. So this is the S&P 500. It just kind of died after that big run this morning. And then the market opened at 7:30 right in New York City. New York City. This is a New York City stock, but we're trading it out of Chicago. You can trade the S&P 500 out of Chicago in the exchanges over there, and there's no pattern day trading rules. That's the great thing about trading out of Chicago. We don't have all those rules that they have over in New York. So you can come over here and you can trade to your heart's content with a small account. So that's a wonderful thing about trading over here. Now, you don't have as many things to trade. You can't go trade Apple. You can't go trade Microsoft. You can't go trade, individual stocks like that. But you do have a lot of things that you can trade. You can trade corn and wheat and soybeans. You can trade crude oil and the gold and silver. You can trade all kinds of really fun stuff over here. There's a whole list of them here. If I come in here and show you, this is the drop down list of all the fun things we can trade. We got Australian dollar, Bitcoin, Canadian dollar, corn, Dow, Ethereum. Yeah, we've even got an Ethereum in here. That's new. And then we got gas. Our Bob is unleaded gasoline. We got gold. We got lean hogs. You can go trade hogs if you want to. We got the NASDAQ. We got a bunch of indexes. Of course, we just mentioned all those. We got platinum and palladium. We got silver, soybean meal, T-notes, T-bills, wheat. We got all kinds of fun things you can trade, but you can't trade individual stocks. All right. We used to be able to. We thought, hey, it'd be really cool. When I was in Chicago, we were like, hey. Of course, I wasn't part of the. I wasn't really part of that, but I was there, and it was a cool thing, and I thought it was going to be neat as heck. I was just like, this is the next best thing since. I'm not going to say sliced bread because that's overused. This is really the coolest thing ever to hit the world. And I thought single stock futures was going to be the next thing because you had no pattern day trading rules. You had your leverage. It was just like trading anything here, only you could trade individual stocks. And I was like, this is going to go to the moon. This is going to be the world's greatest thing that ever happened. And it fell flat. Nobody came and traded with us. And we were all like over here trying to trade our single stock futures, and there's no volume, there's no interest, and we couldn't drag anybody over from New York to come over and trade and show them how great it was and how wonderful it was and how you could do single stock futures on the futures market. And there's no pattern day trading rules. You could trade to your heart's content, and it was just so cool. And you could hedge your markets over on the stock market. And it was just the neatest thing ever. And I was just so excited about it. And I was running around teaching it and telling everybody about it, doing live seminars and webinars all around the country with people. And we were just having so much fun. And we couldn't get anybody to get excited about it. It was like, what is wrong with people? They don't see the greatness in this. And so they had to close that exchange. Isn't that sad? That's a sad story. We used to have single stock futures here in the U.S., but we don't anymore because we couldn't get anybody excited about it. We tried really hard. We tried really hard to get people excited about it. But nobody wanted to come and trade it. I guess we didn't have Facebook at the time, and we couldn't go on there, and YouTube at the time and go on and do all the YouTube stuff. So anyway, there you go. So now we have the traditional contract stuff. Oh, wow. Look at these markets go. Well, I'm sitting here talking and chatting, and I'm not looking at the markets. Look at that, Russell. The Dow. Look at the Dow. These have been some really nice markets. Woo. That's craziness. Holy smokeroonies. How much money is that, Lan? Here, let's draw a dollar calculator. Just from that little arrow right there to where it's currently trading. That's a $240 move with $1,000 investment. You put $1,000 in, take a short position right there, you'd be up $240 right now. Here's another one right there. Look at that. If it just rolled off across the top like that, $140. How about this one here, from here down to here? How about that? This is the micro mini. So this is the tiny one. That's $70 with a $100 investment. If you're still in it all the way from here to here, that's $89 with a $100 investment. You put $100 in, That's a small account challenge, right? That's where you come in and you do your small account stuff on these micro minis. You can still make a lot of money, and you only have to trade with $100. You can open up your account with 2 grand and trade to your heart's content. There's no pattern day trading rules. You don't have to play any of that game. You just come in here and you can bam, 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 trade all you want. There's no rules. Last bastion of true capitalism on earth today. See, I'm doing my job. I'm out here trying to tell people the wonderful things that we can do over in Chicago, and they all want to go over to New York for some reason. I don't know why you guys want to go trade in New York. I guess New York's got its advantages. I like trading in New York too, but man, if you're going to day trade, why in the heck would you go day trade in New York when you can come over here and trade in Chicago with no pattern day trading rules? And look at all these moves in here. These are nice little trend lines, breaking of trend lines. And they're just always remember there's one up for every down. There's one up for every down. You have a down, you have an up. You have a down, you have an up. You have a down, you have an up. The only thing you have to determine is how far, how long the up and down is going to go. And you don't know. And so you just let the software help you. One up for every down. Wait for it to turn. It'll make an up. How far is it going to go? We don't know. Is it going to go up? One up for every down. Sometimes it just goes back and forth, little tiny ups and downs. And that's kind of hard to trade, right? So when you have little tiny ups and down, little tiny up, little tiny down, little tiny up, little tiny down, little tiny up, little tiny down. And then you start getting into the bigger moves, bigger up, bigger down. That's what you want to trade. When it starts making longer ups and longer downs, keep it simple. Just one up for every down, and just wait for the market to start making big ups and big downs, and then only take when you get a little up and a little down, realize those are the counter trends. So and then we got 3 drive pattern. Look at this. Here's drive 1. Here's where's my arrow? Here's drive 1. Here's drive 2. There's drive 3. Does it mean can't make 4 drives? No, certainly can. We're on a very tiny little time frame down here. We're on a micro mini range bar 20 here on the NASDAQ, but that's a 3 drive pattern down right there. We probably don't want to be too excited about taking a short position here. This would be a 4th drive down. Not that you can't, you certainly can. And if you think you want to do it, you can take it. It'd be a break below. There's our little up, right? So we have a down, it's tiny up. The next one would be a longer down. We'd look for a longer down. So right here, we look for this to break down, but it's at the bottom of a 3rd drive. So if you go back to the manual and you look, it says, hey, that's a pretty low probability. Probably don't want to do that. Well, okay, I won't do it. How do you know that's at the 3 drives down? Well, you can turn on the bulls and bears. You turn on the blue lights, right? And it's going to count them for you. There's drive 1, drive 2, drive 3. There's your little counter trends right in there, right? There's your little counter trends. See how it has little blue lights in there? And you have what we call the spider web. So you got the natural trend line, the mathematical trend line, and the vertical or the horizontal trend line. Then you do it again. You got the mathematical trend line, you got the natural trend line, and you got the horizontal trend line. Okay. And in between each one of these are where you're going to get your little triangles and wedge formations. Market's starting to go sideways down here. Doesn't mean it can't break and start to go down and start a new trend on the way down, or it could reverse and start to come back up, or it could just go sideways, right? Markets do that sometimes too. They just go sideways and they don't make any trends. Well, land, what if it's not making a trend? What if it's just going sideways like that and it's not in an Elliott wave? Well, don't trade it. Wait till it starts making Elliott waves and then you can trade it again. Because markets don't always make perfect waves like this. If they did, we'd all be rich, rich, rich beyond our wildest dreams. But right now we have to kind of figure this all out. Sometimes it makes big moves. Sometimes it doesn't. Just realize you got one up for every down. It starts making little tiny ups and downs. Be careful. Don't trade in there because it's not big enough ups and downs. But when it's making some big ups and downs like this, yeah, you can start trading. But realize as it starts getting down into the ends of the drive, 3 drive pattern, the ups and downs start to get smaller. So you have to be careful. All right. You want to look for little shelves, little patterns, recurring price patterns, right? One up for every down. And then when it breaks those patterns, those are good places to get into markets. And then if you get in and the market doesn't do what you think it should do, just immediately get right back out. If it starts making little tiny reversals and it's not making nice big trends, you think it's going to make a nice big trend and you get in and it doesn't, just get back out. It doesn't matter. Take a little tiny loss. Don't stay in there thinking that you're going to, I'll just stay until it comes back. Well, markets can stay irrational longer than you can stay liquid. And they can go a long ways away. And these markets can make and lose a lot of money in a short amount of time. So if you're wrong, just admit it and get out. Don't fall in love with your trade. All right. And that, my friends, is our Sunday school lesson. Don't fall in love with your trade. Perfect your exit strategy. Remember, the only way to bank a profit is to exit the trade. Don't fall in love with your trades. And also, that goes for getting out of a market when you're wrong. At some point, you just have to admit it. I'm wrong. Get out. And the quicker you admit it, the smaller the loss. And there's a saying, Mark Peterson, again, one of my trading buddies, likes to always remind me, Lan, your first loss is your best loss. All right? Because don't turn small losses into big losses, because those are hard to recover. All right, let's go over and say hello to a few people. I haven't said hello to anybody yet. Let's come in. Hey, there's Mark coming in at number 1. Mark Boucher, it's great to see you. We got Gary Thomas coming in at number 2, and Bruce coming in at number 3. We got Kim Moss coming in at number 4. Michael Bruce, you're in there at number 5. Mark Boucher as a former vice president of technology. That's a good story about requirements. Well, good. I'm glad I said something worthwhile today. It's great to have you guys here. Appreciate your comments. Programmers are sandbaggers. That's no doubt, right? No doubt about that. All right, let's see. Michael Bruce says he tried to press his pause button while he went take a leak. It doesn't quite work that way, does it? Market keeps moving, even when we're not looking. Let's see. Michael Bruce says, in his experience, Lan, when it comes to a short time frame trading, the Elliott wave pattern is way important than the Fibonacci is. If you don't know the Elliott wave, you're just using Fibonacci incorrectly. Yep. Well, they go hand in hand. As I always say, it's like French fries and hamburgers. Nobody ever goes to McDonald's and buys a Big Mac and doesn't get the fries. You got to have one with the other. Oh, yeah. It says, tell your son thanks for wanting to trade. Yep. Well, that's kind of what spurred me to write that book. It kind of gave me the emphasis to do it. Emphasis. What is that word? All right. Kirk Schwartz. Great to have you, Kirk. Glad you're here. Good to see you. All right, guys. I'm going to let you go. This markets are having some exciting, fun trends. I want to go trade them. Let's go trade these babies. All right. Let you guys go, and I'm going to go do a little trading on my own. So if you have any questions, let me know out in the comments. If you thought this was a fun class and you learned anything from it, it's always good to see you guys hit those little thumbs up. That always lets me know that you enjoyed what we learned today. And these are some good markets today. Let's go make some money. All right. We'll see you guys tomorrow.